Equinox Gold has reported their final quarter prior to the merger with Calibre Mining, and let's just say we can now see why they want to add the Valentine asset to the portfolio. Well, on a year-over-year basis, the results are quite decent from Equinox. The struggle here is comparing it to the fourth quarter, which was materially better on every metric you can measure. Let's dive in. The first quarter saw Equinox Gold post top-line revenue of $424 million, which was a 76% improvement on a year-over-year basis from the $241 million recorded in the first quarter of 2024. That revenue follows gold sales of 148,000 ounces at an average realized gold price of $28.58 an ounce. Comparatively, Q1 2024 saw the sale of 117,000 ounces at an average figure of $20.66 an ounce. Great on the surface, but things fall apart when comparing to the fourth quarter, which saw revenues of $575 million off the back of 218,000 ounces of gold being sold at $26.36 an ounce, meaning revenue declined by 26% on a quarter-over-quarter basis, while gold sales declined by 32%. Income from mine operations followed a similar pattern, which improved from $11.4 million in the first quarter of 2024 to $33.7 million in the first quarter of 2025, but declined from $170.1 million in the fourth quarter. Net income, meanwhile, was non-existent. Equinox Mining in Q1 posted a net loss of $76 million or 17 cents per share versus a loss of $43 million or 13 cents per share in the year-ago period. The fourth quarter comparatively recorded net income of $28 million or 6 cents per share. On an adjusted basis, net losses amounted to $37 million or 8 cents per share versus $14 million or 4 cents per share in the year-ago period and positive adjusted net income of $78 million or 17 cents per share in Q4. The increase in losses here was blamed on finance expenses rising in the first quarter following the draw on a credit facility alongside unfavorable changes in the fair value of their gold contracts. Layoffs also began in January at Los Filos, resulting in care and maintenance expenses that hadn't been experienced previously. Adjusted EBITDA, meanwhile, came in at $138 million, which compares to $52 million in the year-ago period and $218 million in the prior quarter. And in terms of cash flow, operating cash flow before changes in non-cash working capital improved from $48 million last year to $73 million in the current quarter, while being down from $213 million in Q4. Equinox ended the quarter with cash and cash equivalents of $173 million, down from $239 million as of the end of 2024, while net debt increased from $1.1 billion to $1.2 billion over the course of Q1. All right, let's move on to the production data, which also was not great. Gold production in the first quarter totaled 145,000 ounces, as compared to 112,000 ounces in the year-ago period and 214,000 ounces in the fourth quarter. Cash cost per ounce sold, meanwhile, increased 13% year-over-year, moving from $15.67 to $17.69 an ounce, while jumping 21% from the $14.58 figure recorded in the fourth quarter. All-in sustaining costs fared the same, climbing from $19.50 to $20.65 an ounce, while notably crossing the big $2,000 an ounce mark. AISC, meanwhile, was up an eye-watering 25% on a quarter-over-quarter basis from $16.52 an ounce in Q4. So, what went wrong? Well, Greenstone apparently is ramping down rather than up. Gold production here fell from 53,000 ounces in the fourth quarter to 44,000 ounces in Q1, with grades dropping from 1.26 grams per ton to 1.06. Recoveries also went backwards, dropping from 82% to 80.7%. Costing, as a result, ballooned here, with cash costs moving from $10.41 to $15.70 an ounce quarter over quarter, while AISC moved from $11.41 to $18.36 an ounce. And to top it off, they had unplanned downtime due to cold weather. Who'd have thought it'd get cold in Canada? Perhaps a bit more planning here was required. Mining rates are said to have improved throughout the year, and guidance is still calling for 300 to 360,000 ounces of gold this year at cash costs between $790 and $890 an ounce, and AISC of $10.45 to $11.45 an ounce. But we'll see if that happens. Outside of Greenstone, production was down across the board. Mesquite produced 12,000 ounces versus 17,000 ounces in Q4. Arizona produced 16,000 ounces in Q1 versus 24,000 ounces in Q4. The Bala complex produced 28,000 ounces versus 33,000 ounces last quarter. RDM produced 11,000 ounces versus 21,000 ounces in Q4. And Los Filos produced 32,000 ounces in Q1 versus 61,000 ounces in Q4, and is now in care and maintenance as a result of failing to meet a land agreement with the local community. Overall, guidance for 2025 is calling for annual production of 635 to 750,000 ounces of gold on a consolidated basis, at cash cost between $10.75 and $11.75 an ounce, and AISC of between $14.55 and $15.50 an ounce. But at this rate, we'll see if that's even possible. Those estimates also are said to exclude Los Filos, so the production figure is even more distant. All right, so let's wrap it up. Investors are arguably dissatisfied with the Q1 results, and rightfully so. Ramp up at Greenstone is a mess, production is down across the board, and no amount of commentary on this being the highest first quarter production in the company's history is going to be enough lipstick to make things right. Investors are now convinced that the arrangement with Calibre, who had their own issues in the first quarter, was simply used as a smokescreen for the bad results. And I mean, long term, things here will be fine. But investor dollars can be fickle, and well, this wasn't exactly a quarter that inspired a lot of confidence. On the bright side, as at John Allwright over on the CEO.ca board said, we'd be surprised if Barrick doesn't buy this one for the management team alone. And for those that don't get the joke, check out our coverage on Barrick's earnings on our channel. All right, everybody, thanks for watching. We are in the thick of earnings season. If there's stories you want us to cover, let us know in the comment section. We've got lots of earnings videos for you guys. We're trying to get to as many as we can basically every day. So you're noticing a little bit more content this last week and probably next week as well. We're going to be at a conference, so there's going to be lots of new interviews, but we're going to try to keep going with these earnings videos while we are in conference mode, because we know how much those of you who enjoy this content want us to keep going. So we're going to keep delivering for you guys. All right, everybody. Thanks for watching.